Why have mortgage rates stopped climbing, yet your dream of homeownership feels further away than ever? Imagine standing on the shoreline of the American dream, watching as the turbulent tides of interest rates finally begin to settle into a deceptive calm after years of extreme volatility. For nearly 2 years, the Federal Reserve has dominated every financial headline, wielding its blunt instruments of monetary policy to cool an overheated economy, leading many prospective buyers to believe that a plateau in rates would finally signal a return to affordability. However, a jarring paradox has emerged from the latest data released by the National Association of Realtors, showing that while mortgage rates have indeed stabilized, the median home price in the United States has surged by an additional 5% over the past year. This phenomenon shatters the conventional wisdom that high borrowing costs would eventually force sellers to lower their expectations, revealing a much darker reality where the gate to homeownership is being welded shut by forces far more complex than a simple percentage point. The psychological toll of this trend is immense, as millions of hardworking individuals find themselves trapped in a state of perpetual waiting, convinced that if they just hold out a little longer, the market will surely correct itself and return to some semblance of historical sanity. This sense of hope is often the very thing that blinds us to the underlying structural rot of the current housing landscape, where a massive supply-demand imbalance has rendered traditional economic models nearly obsolete for the average family. We must ask ourselves the difficult question of why the cooling of inflation has failed to translate into a break for the middle class, and what it truly means when the most basic human need for shelter becomes a luxury asset that appreciates regardless of the broader economic climate. As we peel back the layers of this financial mirage, we begin to see that the stability we were promised is nothing more than a temporary mask for a deep-seated inventory crisis that is silently rewriting the rules of wealth accumulation in America. If the price of entry is rising while the available options are vanishing, we must ask, what is the hidden force that has turned the American home into a fortress of scarcity? What is truly controlling your wallet and preventing home prices from falling even as the broader economy shows signs of fatigue? To find the answer, we must look beyond the standard supply and demand curves and examine the psychological phenomenon known as the lock-in effect, which has effectively paralyzed the American resale market. During the era of ultra-low interest rates sparked by the global pandemic, millions of households secured fixed-rate mortgages at historic lows of 2 or 3%, creating a financial anchor that now prevents them from moving. For these homeowners, the prospect of selling their current residence and purchasing a new one would mean trading a manageable monthly payment for a significantly higher debt obligation at current market rates. This creates a powerful inertia, where the logical choice for the individual is to stay put, even if their life circumstances suggest they should move, thereby choking off the lifeblood of the housing market, which is the steady flow of existing homes for sale. The data provided by the Federal Reserve and the National Association of Realtors paints a stark picture of this structural gridlock where nearly 2/3 of all outstanding mortgages in the United States are currently sitting at rates below 4%. When you realize that the average 30-year fixed mortgage rate has spent much of the past year hovering significantly higher, the mathematical gap becomes an insurmountable wall for the average family. This massive disparity has resulted in a situation where the inventory of available homes has plummeted to levels that are nearly 40% lower than the pre-pandemic norm, creating a scarcity that defies the traditional gravity of high interest rates. In this environment, the few houses that do reach the market are met with a frenzy of desperate buyers who are competing for a dwindling pool of resources, ensuring that prices remain elevated despite the increased cost of borrowing. We are witnessing a fundamental shift where the American home has been transformed from a place of shelter into a frozen asset that owners are terrified to let go of for fear of being priced out of the market forever. This collective hesitation creates a feedback loop where the lack of inventory drives prices higher, which in turn makes the cost of moving even more prohibitive for those who might otherwise consider selling. This is the invisible hand that is currently squeezing the financial life out of prospective buyers as they are forced to compete not just with each other, but with a ghost inventory that remains locked away behind the golden handcuffs of low interest debt. The result is a market that feels more like a private club with a closing door than a functioning pillar of the national economy, leaving those on the outside looking in with a sense of profound frustration and helplessness. Furthermore, the persistent shortage of existing homes has forced many buyers into the new construction market, where large-scale developers are often the only entities capable of providing any significant volume of inventory. While these builders have attempted to bridge the gap, the pace of construction remains hampered by labor shortages and high material costs, ensuring that the overall supply remains far below what is necessary to satisfy the current demand. This systemic failure to provide enough housing units has fundamentally altered the power dynamics of the real estate industry, allowing sellers to maintain a dominant position even in a high-rate environment. By understanding that this inventory chokehold is a product of both past policy decisions and current human psychology, we can begin to see why the simple stabilization of rates is not enough to break the fever of rising prices. As we stand in the middle of this inventory desert, it becomes clear that the old ways of calculating whether a home is a good investment must be discarded in favor of a more rigorous and cold-blooded analysis of the numbers. If the traditional path to wealth through property ownership is being blocked by a historic supply crunch, we must find a new way to measure the true cost of our housing decisions and determine if the price of admission is still worth the potential reward. This leads us to a critical realization that the math of the modern market is fundamentally different from that of our parents or even our older siblings. What if the most important calculation you make this year has nothing to do with the sale price of a house and everything to do with the hidden mechanics of your own financial future? What is the core mathematical formula that will fundamentally alter your financial trajectory in a market where prices have jumped another 5% despite the stabilization of mortgage rates? To answer this, we must strip away the emotional layers of homeownership and look at the cold, hard reality of the total cost of capital, which remains the most misunderstood aspect of the American dream. Many buyers focus solely on the monthly mortgage payment as their primary metric of affordability, but this is a dangerous oversimplification that ignores the massive burden of interest, taxes, and maintenance over a 30-year horizon. When you factor in the current average mortgage rates alongside a 5% year-over-year increase in property values, the break-even point for a new purchase has shifted dramatically further into the future than at any point in the last 4 decades of financial history. Consider the hidden mechanics of property ownership that are often omitted from the glossy brochures of real estate agents, such as the compounding cost of property taxes and homeowner insurance, which have both seen double-digit increases in many American states recently. According to research from Vanguard and other major financial institutions, the opportunity cost of tying up a massive down payment in an illiquid asset can be staggering when compared to the historical returns of a diversified portfolio in the S&P 500. If you take $100,000 and place it into a house that is appreciating at 5% while simultaneously paying thousands in annual maintenance and interest, you might actually be losing wealth in real terms compared to a liquid investment that compounds without the friction of transaction fees and physical decay. The true power of financial mechanics lies in understanding the velocity of your money and whether it is working for you or for the bank that holds your deed for the next 30 years. For a modern investor, the goal is no longer just to own a piece of land, but to maximize the efficiency of every dollar earned in an environment where the cost of living is relentlessly rising and supply is artificially constrained. We must perform a rigorous analysis of the rent-to-price ratio in specific zip codes to determine if the premium paid for ownership is actually a purchase of freedom or a lifetime of financial servitude to a depreciating its structure. By looking at the math through this lens, we see that the dream of a white picket fence can sometimes be a statistical trap that prevents you from reaching true economic independence before your prime years are gone. This mathematical shift forces us to reevaluate the very foundation of what we consider to be a safe investment and challenges the long-held belief that a primary residence is always the best place to park your life savings. As the gap between wages and housing costs continues to widen, the ability to pivot and remain mobile becomes a valuable asset in its own right, one that cannot be easily measured on a balance sheet, but provides immense psychological and professional advantages. When you master these core arithmetic principles, you stop being a victim of market trends and start becoming a strategic architect of your own wealth, capable of seeing through the noise of a 5% price hike. However, to truly weaponize this knowledge, we must first address the fundamental way we perceive the concept of value itself and how it differs from the illusions of the crowd. What is the real difference in the mindset regarding wealth when the traditional paths to success seem to be crumbling under the weight of a 5% annual price hike? To understand this fundamental shift, we must first confront the deep-seated cultural programming that has equated homeownership with the ultimate achievement of the American middle class for nearly a century. This narrative has created a scarcity mindset where individuals feel a desperate, almost primal urge to secure a piece of property at any cost, fearing that if they do not act now, they will be permanently exiled from the ranks of the financially stable. However, the truly strategic mind recognizes that wealth is not merely the accumulation of physical structures, but rather the mastery of liquidity and the preservation of one's greatest asset, which is time. In a market where prices are inflated by a historic supply crunch and stagnant inventory, the decision to remain on the sidelines is not a sign of failure, but a calculated move to maintain financial optionality in a rapidly changing world. The distinction between status and actual wealth is often blurred by the shimmering mirage of home equity, which can leave many families house rich but cash poor. A primary residence is essentially a consumption item that happens to have a fluctuating market value, requiring constant infusions of capital for taxes, insurance, and the endless decay of its physical components. When you shift your perspective to view your home as a service you pay for rather than a guaranteed golden ticket to retirement, the math begins to look very different. Those who possess a wealth mindset understand that true economic power comes from assets that generate cash flow, not from the walls that demand it every month. By decoupling their identity from the deed of a house, these strategic players are able to deploy their capital into more productive vehicles, such as diversified equities or private ventures, which often provide far greater long-term returns without the soul-crushing weight of a 30-year debt obligation. This transition from a scarcity mindset to an abundance mindset requires the courage to ignore the judgment of peers who may view renting as throwing money away while they themselves are drowning in the hidden costs of ownership. There is a profound strategic advantage in being mobile and liquid during a period of economic transition, allowing you to move where the highest paying jobs are located or to pounce on distressed assets when the market eventually recalibrates. The opportunity cost of ego is perhaps the most expensive tax one can pay in the world of personal finance, as the desire to look successful frequently prevents the actual accumulation of success. By choosing to look poor in the short term by renting a modest space and aggressively investing the difference, you are essentially buying back your future freedom from a system that thrives on keeping you anchored to a single zip code and a lifelong mortgage. We must also recognize that the fear of missing out is a weaponized psychological tool used by the real estate industry to drive transactions even when the underlying fundamentals are broken. The abundance mindset allows an individual to step back from the frenzy and realize that there will always be another deal and another cycle, provided they have the capital and the patience to wait for it. This level of discipline is rare because it requires fighting against the collective social pressure of a society that measures a person's worth by the square footage of their living room. When you finally break free from this narrow definition of prosperity, you gain the clarity to see that a house is just one tool in a much larger financial toolkit, and sometimes the best way to use that tool is to keep it in the shed until the price is right. Ultimately, The goal of this mindset shift is to transform yourself from a passive participant in the housing market into a deliberate architect of your own financial destiny. This means prioritizing the growth of your net worth over the size of your mortgage and understanding that a lifestyle of flexibility is often more valuable than a lifestyle of fixed assets. As we move forward into an era of persistent supply shortages and shifting demographics, the ability to think independently of the crowd will be the primary factor that determines who thrives and who merely survives. By redefining what a roof over your head actually represents, you empower yourself to make decisions based on logic and long-term strategy rather than fear and social expectation. This newfound clarity is the essential foundation you need before you can take the practical, actionable steps required to navigate the current housing storm without losing your shirt. What specific steps should you take the moment you finish this video to avoid being crushed by a market that is increasingly hostile to the average buyer? The first and most critical action is the aggressive optimization of your FICO credit score to ensure you have access to the absolute lowest interest rates available from lenders like Fannie Mae and Freddie Mac. Even in a period where national rates have stabilized, the tiered pricing systems used by major financial institutions mean that a borrower with a score above 760 will save tens of thousands of dollars compared to someone with a mediocre rating. You must meticulously review your credit report for any inaccuracies, dispute old errors, and keep your revolving credit utilization below 10% to signal to the banking system that you are a low-risk candidate who deserves the best terms. This preparation is the equivalent of sharpening your blade before a battle, as a lower interest rate is the only real way to mitigate the impact of the 5% surge in home prices that we have seen over the past 12 months. Secondly, you must shift your savings strategy toward high-yield vehicles such as high-yield savings accounts or treasury bills that currently offer yields significantly higher than traditional checking accounts. While you wait for the inventory crisis to show signs of easing, your down payment must not sit idle, but should be working to outpace the rate of property appreciation as much as possible. Maintaining a large, liquid cash reserve provides you with the ultimate leverage, which is the ability to walk away from overpriced bidding wars that are fueled by the desperation of other buyers. This liquidity serves as a psychological fortress, allowing you to remain patient and disciplined while others are making emotional mistakes that will haunt their balance sheets for decades. By earning a steady return on your capital while it remains accessible, you position yourself as a flexible hunter in a market full of trapped prey who are forced to accept whatever terms the current inventory allows. Finally, you should consider the tactical advantages of house hacking or investigating emerging niche markets where the price-to-rent ratio is still favorable for the savvy investor. House hacking allows you to purchase a primary residence with the intent of renting out a portion of the property, such as a basement apartment or a spare bedroom, to generate immediate cash flow that covers a significant portion of your mortgage. This strategy effectively lowers your cost of living and accelerates your path to equity, even in a high-price environment where traditional ownership feels like a burden. Alternatively, looking at secondary markets or path of progress neighborhoods where supply is expected to increase can provide opportunities for appreciation that far exceed the national average of 5%. These steps require a move away from the conventional buy and hold mentality and toward a more entrepreneurial approach to housing that treats every square foot as a potential profit center. Once you have mastered these practical moves, you will be prepared to face the final and most dangerous challenge, which is the deceptive trap of success itself. What is the ultimate trap that can strip away all your hard-earned progress and throw you back to the financial starting line just when you think you have finally won the game of homeownership? This danger is known as the psychological wealth effect, where the modest 5% increase in your home value creates a false sense of prosperity that encourages reckless spending in other areas of your life. When you see your net worth rise on a digital estimate, your brain releases dopamine that convinces you that you are wealthier than you actually are, often leading to the disastrous decision of tapping into home equity through risky loans or increasing your monthly overhead. You must realize that paper wealth in an illiquid asset like a primary residence cannot pay for groceries or fund a retirement portfolio if the market suddenly shifts or if your income is interrupted. Staying disciplined when the crowd is celebrating their rising equity is the only way to ensure that your home remains a sanctuary rather than a ticking financial time bomb that could explode at the first sign of an economic downturn. The phenomenon of lifestyle inflation acts as a silent predator that stalks successful individuals, waiting for the moment they feel secure enough to lower their guard and increase their standard of living to match their perceived house-rich status. Many families who have benefited from the recent surge in property values find themselves succumbing to the temptation of upgrading their vehicles or committing to expensive private schools, effectively neutralizing the gains they have made in their real estate holdings. This creates a state of perpetual financial fragility where you are forced to maintain a high-stress career just to service the debt and maintenance costs of a lifestyle that you cannot truly afford without the crutch of rising home prices. By avoiding the allure of these sugar-coated traps, you maintain the critical margin of safety required to navigate the inevitable cycles of the United States economy without losing your peace of mind or your long-term autonomy. True wealth is not found in the luxury items that sit in your driveway, but in the number of days you can live without a paycheck while maintaining your dignity and your strategic options. As we circle back to the image of the shoreline we discussed at the beginning of this journey, we can now see that the mirage of stability was merely a temporary distraction from the deeper structural shifts occurring in the American landscape. The 5% price increase that initially felt like an insurmountable wall is actually a signal to the wise investor that the old rules of the game have been permanently rewritten in favor of those who prioritize liquidity over prestige. If you have followed the logic of this analysis, you understand that the current inventory crisis is a double-edged sword that rewards the disciplined while punishing those who rush into the market out of a primal fear of being left behind. The stability of mortgage rates should not be viewed as an invitation to over-leverage your future, but rather as a moment of calm to refine your strategy and fortify your financial foundation for the challenges that lie ahead in the coming decade. Remembering the pain of the previous housing cycles will serve as your greatest defense against the collective amnesia that often precedes a major market correction in the real estate sector. The most important lesson you can take away from this exploration is that your financial worth is not defined by a deed or a zip code, but by the strength of your character and the resilience of your investment strategy. Do not let a pile of bricks and mortar become a set of golden handcuffs that prevent you from pursuing the career opportunities or the personal adventures that give life its true meaning and vibrancy. By focusing on the mechanics of wealth, such as compounding interest and strategic capital allocation, you ensure that you are the master of your money rather than its servant in an increasingly expensive and complex world. The path to true freedom is rarely the most popular one, and it requires the intestinal fortitude to say no to a bad deal even when everyone else is shouting that you should buy now or miss out forever. As the housing market continues its unpredictable evolution, your commitment to these core principles will be the lighthouse that guides you through the fog of economic uncertainty and toward a future of genuine prosperity. In conclusion, the current landscape of the American housing market is a test of your psychological resolve as much as it is a test of your financial acumen or your ability to calculate a down payment. While the headlines focus on the 5% growth and the stagnant supply, the real story is being written by those who have the vision to redefine their relationship with property and the discipline to execute a long-term plan. Success in this environment is not about following the herd into a high-priced trap, but about building a fortress of liquidity that allows you to act with confidence when others are paralyzed by the fear of a changing world. Stay focused on your actionable steps, keep your eyes on the true prize of freedom, and never allow the temporary illusions of a volatile market to distract you from the enduring laws of mathematics and human psychology. Your future self will thank you for the restraint you show today and the strategic wisdom you employ to navigate the complex waters of the modern American dream. The house is a tool, not a cage. Build wisely, invest boldly, and live freely.